I'm Mark Anthony G. Codilla, and we'll continue on the discussion of the foreign exchange market. So there are three broad categories of an exchange rate system. Number one would be a free-floating exchange rate system. This is where governments and central banks do not participate in the market for foreign exchange. So in this concept of a completely free-floating exchange rate system is a theoretical one. Why do we say that? Because in practice, all governments or central banks intervene in currency markets in an effort to influence exchange rates. Because in a free-floating exchange rate system, this acts as a buffer to insulate an economy from the impact of international events. That's why central banks or governments intervene when it comes to like something that happens that affects the exchange rates. So the primary difficulty with free floating exchange rate lies in their unpredictability. The second exchange rate system would be the managed float exchange rate system. So this is where government or central bank participates in a floating exchange rate system. So countries that have a floating exchange rate system intervene from time to time in the currency market in an effort to raise or lower the price of their own currency. So just what I've said just now, a free floating in practice, governments or central banks intervene with the influence of the exchange rate so that they can lower or higher the price of their own currency. So this is called a managed float exchange rate system. The next on our list is the fixed exchange rate system. So this is where the exchange rate between two currencies is set by a government policy. So in a commodity standard system, countries fix the value of their respective currencies relative to a certain commodity or a group of commodities. With each currency's value fixed in terms of the commodity, currencies are fixed relative to one another. So for centuries, the value of many currencies were fixed relative to what? To gold. So under the gold standard, the quantity of money was regulated by the quantity of gold in a country. So the higher the gold, the richer you are, or the expensive your currency is. So in recent years, a number of countries have set up a currency board arrangements which are a kind of commodity standard. So in its simplest form, this type of arrangement implies that domestic currency can be issued only when the currency board has an equivalent amount of the foreign currency to which the domestic currency is pegged. Foreign exchange rate is defined as the price of the domestic currency with respect to another currency. The purpose of foreign exchange is to compare one currency with another for showing the relative values. So there are two ways to quote or to calculate these currencies. Or to compare it. It's either through a direct quote or an indirect quote. So a direct quote is an exchange rate quotation in the foreign exchange market. So it quotes a fixed unit of a foreign exchange currency against a variable of the domestic currency. So in other words, a direct quote depicts the amount of foreign currency that can be bought for a certain unit of the domestic currency. So for example, if the exchange rate between the US dollar and the Chinese yuan is 0.56 yuan per US dollar, it is a direct quote for China, as the domestic currency for China is represented per unit of the US dollar, which is the foreign currency. On the other hand, the other form or the other way of quoting or calculating the currency or comparing it is through an indirect quote. It's also known as a quantity quotation, which is a reciprocal of the direct quote. So it shows how much foreign currency is needed to purchase one unit of a domestic currency. So unlike a direct quote, which prices one unit of a foreign currency in terms of variable units of a domestic currency, indirect quotes use the domestic currency as the base. So in practical terms, if the exchange rate drops in an indirect quote, this indicates that the domestic currency is depreciating. So, for example, the Canadian dollar trading at 1.25 to the USD as an example. So in Canada, the indirect quote is 1 Canadian dollar equals $0.8 of US. So it's 1 divided by the rate, which is 1.25, which you will have 0.8. So that's the indirect and the direct quote. So what is the impact of the foreign exchange rate to the international trade? Well, when currency appreciates or when it becomes strong, it makes a country's exports more expensive for the foreigners and the imports much cheaper for the domestic buyers. So exporters prefer their currency to depreciate. So when it comes to depreciation of the currency or the weakening of currency, this makes the country's exports cheaper for the foreigners and the imports more expensive for the domestic buyers. So importers prefer their currency to appreciate so for them to be able to purchase imported goods, while exporters prefer it for the currency to depreciate so that they could sell their exported goods. There are 7 factors that we have to consider that influences the foreign currency exchange rate. Number 1, supply and demand. So the exchange rate is the reflection of the balance between the supply and the demand for the currencies. Interest rates and the overall strength of the economy are the 2 primary factors that affect the supply and the demand. They are responsible for the changes in the supply and demand of the currency that ultimately affects the exchange rate of the country. Next, number 2 would be inflation. So inflation refers to the relative purchasing power of a currency of one country against another country. Thus, the cost of buying 1 unit of a certain product in one country may be lesser compared to another product with higher inflation when purchasing the same product. So the differences in inflation serves as a basis for why different currencies have varying purchasing power and currency rates. So it tends to show that those with lower inflation have stronger purchasing power as compared to those with higher inflation. Number 3 on our list is the interest rates. So interest rates are highly correlated with inflation and exchange rates. As we know, inflation is one of the factors that influences exchange rate. Because of its high correlation, the central bank uses its interest rates to reduce the inflation within the country. A country with high interest rates attracts foreign capital because it helps strengthen the local currency rates. However, if this remains to be high for a long period of time, this would cause inflation to sneak up, resulting in a devalued currency. And also, a high interest rate is not good for the stock market because investors will start selling the stocks, causing the country's currency to weaken. Number 4 on our list is the balance of trade. The balance of trade depicts the net difference between the exports and the imports of the country. So when the value of the exports is lower than the imports, there will be a deficit in the balance of trade, which is considered to be not favorable. But when the exports is higher than the imports, money will flow into the country, which will in turn increases the value of the currency. Number 5 on our list is the government interventions. So as we know, with the exchange rate system, government tends to intervene so that the currency wouldn't be weakened. So this normally happens when the regulatory body of the country, like for example the Central Bank of the Philippines or the Bangko Sentral or the BSP, directly intervenes to regulate the exchange rate of the currency by revaluation, devaluation, or manipulating the flow of foreign currencies to meet or maintain the desired exchange rate. 6 on our list is the political stability. So having a stable politics is one of the most important aspects of attracting foreign investments, because who would invest in a country wherein there are a lot of problems like corruption or even chaos or war? Last on our list is public debt. Well, the Philippines relate to this much. As we know, the Philippines is in a lot of debt. So many countries like the Philippines prop up the economy to borrow money to finance economic growth and support various government spending. But when that exceeds more than what we can earn, it could increase inflation and discourage the foreign investments. So sometimes, like other countries, they would print more money, which in turn would decrease the value of the currency. That's why it could also affect the currency value. That's why the Philippines will have to consider all of these 7 factors, so that, because it's alarming, our foreign currency exchange rate to US dollar is currently a big one, and it shows that our country is really weakening its economy. So we have to consider these 7 factors.